Alright, just a quick note before we start. I have added a clickable list of topics covered in the video in the description below here. You can see the list of topics along with the timestamps here. So if you wish to jump to any specific topic, you can do so by clicking on the timestamp. Let's say in this video you wanted to directly jump to shifting of securities. So you can just click it here and it will take you there. The other useful way to navigate across topics is by hovering over the progress bar. It will show the progress bar split into various sections of the video. So different topics get highlighted when you hover your mouse over. So if you wish to jump to any section, you can do so by simply clicking there. Alright, here's the list of topics that we are going to cover in this video. We'll start with the basic terminology and concepts such as face value, book value, market value, acquisition cost. Then look at the classification, the three types of classification, HTM, AFS, HFT. Then we'll move on to the calculations and accounting related to premium amortization in case of securities categorized as a HTM. Then we'll move on to the concept of marking to market, which is done for the AFS HFT portfolio. We'll look at the IDR requirement calculation, then the often confused IDR versus IFR will be covered. Next, we'll take a look at the shifting of securities, and primarily we'll look at shifting of securities to and from HTM, the motivation behind and the related entry. And lastly, we'll cover income recognition. First on accrual basis, which is typical for the government securities, then on cash basis, which we see in case of mutual funds, and the issues that are commonly observed there. Alright, let's start with the basics. When you look at any investment, there are four types of values that you will typically come across. First is the face value or the par value. Second is market value. Third is acquisition cost. And the fourth is book value. Let's look at them one by one. So what is face value or par value? So the notion of par value or face value comes when we look at investments such as bonds. So bonds in our case issued by government are mostly of two types, the treasury bills or the government securities. Treasury bills are for short term or less than a year. Government securities are for the longer term, longer duration, typically more than 1 year. So face value for these is typically in the multiples of thousands. Next comes the market value. Market value is the value or price at which the security is currently trading over the exchange. It could be at a premium or at a discount. Premium meaning its value is more than the face value. Discount meaning it is less than the face value. This premium or discount could be due to n number of reasons. It could be because of its coupon, because of the credit rating of the issuer or the issue, the benchmark interest rate, or the liquidity conditions. The market value of government securities are available on the FBL website. Now we'll look at the acquisition cost. Acquisition cost is the cost at which the security was purchased by the bank. So it's the market value at the time of purchase. And lastly, the concept is book value. So book value is the value of that security which was purchased at any point in time on the books of the bank. And mostly we'll see it's the same as the acquisition cost except for two scenarios. The first one is while amortizing premium of security under the HTM category, and the second is while shifting of securities from one category to another when the market value is less than the book value. Alright, so the investments that we make are typically classified into three categories. The HTM, which is held to maturity, then there is HFT, which is held for trading, and then there is AFS, which is available for sale. This HFT and AFS is also known as the trading book. So the first category is HTM. Any security is labeled or classified as HTM by the bank when the intent to buying the security was to hold it till maturity. It was not to trade or to speculate or make short-term gains. So under HTM you will primarily find the securities which have been purchased by the bank for the intention of fulfilling the SLR requirements. So since SLR requirement is mostly known or constant, so HTM category fits very well there. The other reason you can think of banks to classify any security as HTM could be to avoid any mark to market provisioning. So mark-to-market is done typically when there is adverse movement in price of any security that we are holding. So you have to book a notional loss that has happened. But in case the security is under HTM, there is no such requirement. That's why bank prefer to label securities as HTM. So you can hold your securities in HTM and you don't really have to worry about anything such as the what's happening, the market volatility or the uncertainty or the prices. Once you have labeled it as HTM, you can pretty much keep it there and forget about it. But there's a catch. You cannot put all your securities under HTM. There's a limit, and that limit is 25%. So what our circular says is investments included under HTM category should not exceed 25% of the total investments of the bank. However, the banks are permitted to exceed the limit of 25% of their total investments provided two conditions are met. The first condition is the excess comprises only of SLR securities, and the second is the total SLR securities held under HTM is not more than the 25% of NDTL. So how do we get to know whether a security is SLR or not? The status of securities issued by Government of India and the state governments will be indicated in the press release issued by RBI at the time of issuance of securities. Alright, now let's shift our focus to the other two classifications, the HFT and AFS. HFT or held for trading securities. These securities are acquired by the bank with the intent of trading by taking advantage of the short-term mispricing or the interest rate movements. Alright, the last category is AFS. So the securities which do not fall under the previous two categories are classified as AFS securities. So whenever a bank buys a security, it has to label them in one of these three categories at the time of investment itself. The banks are permitted to shift securities across categories at a later stage, but that is done with various limitations and restrictions. So one restriction that our circular puts on the non-SLR security is that all investments under non-SLR category should be classified under HFT or AFS only. There is one exception to this, which is the investment in long-term bonds issued by companies engaging in infrastructure projects and having a minimum residual maturity of 7 years. So only these kind of non-SLR securities can be classified as under the HTM category. Except this, all the non-SLR investments will have to be mandatorily classified as either HFT or AFS. Alright, now we look at the concept of premium amortization. So this is applicable to bonds purchased at a premium and classified under the HTM category and not under the AFS or HFT category. It's not applicable there as their book value never changes. As we had discussed previously, the book value changes in only two cases: when the security has been purchased at a premium under the HTM category and while we shift the securities across categories and the market value is less than the book value. So it's one of those two cases when we change the book value. Alright, let's look at an example. Say bank purchased a government security for 106 and this has a residual maturity of 3 years. So this 106 has two components. 100 is your principal and 6 is your premium. Remember, the principal or the par value or the face value are one and the same thing. So this 100 is the principal that we are going to get back at the time of maturity and this 6 is the premium. So we offer the banks a choice in terms of how it wants to amortize this premium. They can do it by amortizing all of it in one go, or it can evenly distribute this premium across the residual maturity. So whatever way it chooses, the idea behind is that at the end of the maturity, there should be no premium left. So this was 106. So at the time of maturity, this 6 should be completely gone. Because if it doesn't happen at the time of maturity, let's say it remains at 105, we know that at the end of maturity, we are going to get 100 as return only because we only get principal at the end of maturity. So the book value was 105 and we received 100, which means we had a loss of 5. This should not happen. So by the end of the maturity, it should get reduced to 100 so that when we receive a cash of 100 as a principal, there should be no loss happening. Alright, let's say the bank decided to amortize the premium equally across the years. Let's say in the year 1, in the first year, we'll reduce it by 2, in the second by 2 again, in the third by 2 again. In the fourth year, we'll reduce it by 1 again. In the fifth year, we'll reduce it by 1 again. In the sixth year, we'll reduce it by 1 again. In the seventh year, we'll reduce it by 1 again. In the eighth year, we'll reduce it by 1 again. In the ninth year, we'll reduce it by 1 again. In the tenth year, we'll reduce it by 1 again. In the 11th year, we'll reduce it by 1 again. In the 12th year, we'll reduce it by 1 again. In the 13th year, we'll reduce it by 1 again. In the 14th year, we'll reduce it by 1 again. In the 15th year, we'll reduce it by 1 again. In the 16th year, we'll reduce it by 1 again. In the 17th year, we'll reduce it by 1 again. In the 18th year, we'll reduce it by 1 again. In the 19th year, we' So the book value will change. In the first year it will become 104, in the second it will be 102, and at the time of maturity it will be 100. So we are creating this GSEC account in the first year by 2. So correspondingly there will be a debit entry. That debit entry will be booking a amortization expense in the P&L. So for the first year we'll be debiting the P&L by 2. The second will be debiting it by 2 again, and third will be debited by 2. You can notice here that there is no cash transaction happening. Why is it so? Because when we purchased the security, we had reduced the cash by 106, right? So the premium was already paid as cash at the time of purchase. It's just that we are recognizing it now in the P&L as we are amortizing it over the years. Had the bank amortized the premium in the first year itself, we would have credited the asset in the first year itself by -6, and the book value would have reduced to 100. Correspondingly, in the P&L, we would have debited the P&L by 6 itself in the first year. This is permitted because the bank is being conservative here by recognizing the expense early. Alright, at this juncture, let me discuss a finer point. Let's compare and contrast financial assets such as bonds and advances to fixed assets such as computer, buildings, furniture. What we are going to do is we are going to compare the impact of these two categories on the balance sheet and P&L over time. One common thing is that these both have finite lifetimes. For bonds, we have the concept of maturity. For advances, there is fixed tenure. For fixed assets, we have concept of useful lifetime. Alright, let's look at an example. Let's say this bank purchased bonds and gave out advances of 100 rupees each, and also purchased a fixed asset, let's say computer, of 100. So we debited all these three accounts and we credited cash by 300 for purchasing all these three. So when we purchased a bond or gave out advance, we created a financial assets. Whereas when we purchased a computer, we created a fixed asset. So far, there is no impact on the P&L. What we know for computer is that we are going to depreciate it over time. For computers, lifetime is 3 years. So each year it will get decreased by 33. So each year we are going to credit it and debit the P&L by depreciation for 3 years. See, for financial assets, we have a concept of principal. This principal of 100 in case of bonds and advances is going to come back at the end of maturity. Whereas in case of computers, this principal amount at the end of 3 years, it's going to become 0. Whereas at the end of maturity, for financial assets, we'll get the principal back. And for the years that we are holding this investment or that we have given this advance, we are going to get interest income. So this is the P&L impact that we are seeing. Whereas for a computer, the money that we invested, the total amount, the principal itself is getting exhausted in the P&L. Whereas for bonds and advances, at the end of the maturity, when I get my 100 back, what is going to happen is I'll get a cash here and I'll reduce the bond amount. When I get the principal amount from the advance back, I'll increase the cash by 100 and I'll decrease this advance by 100. There is no impact on P&L. The only time when the impact on P&L is going to happen is in case this turn out to be non-performing investment or advances. At that point, I'll have to create a provision by debiting the P&L. Otherwise, there is no impact. Or in case of bonds, whenever there is mark to market, even at that time, this principal value will not change, and this too will happen if the bond is in AFS or HFT. If I hold this bond till maturity, then I'm certain to get 100. I'm trading it before maturity, that there could be implication in terms of the loss of the principal. Otherwise, my principal stays in both these cases. In case of fixed assets, this capital expenditure that we did gets gradually converted into expense in the P&L. Alright, let me quickly show you why an example is scenario wherein everything will look perfectly fine from an accounting standpoint, but it will be totally wrong fundamentally. Let's say government security was trading at a discount of 5% at 95. Let's say a bank purchased it. So the cash will be credited by 95 and the investment will be debited by 95. But instead of debiting at 95, what we have observed in certain banks is that what they do is they'll rather debit it by 100, which is the face value, instead of the acquisition cost, and correspondingly book a discount income of 5. So when you try to see, the trial balance is telling the net balance here is minus 95 plus 100 plus 5 on the debit side and plus 5 on the credit side. The trial balance is telling, and you might wonder what has happened. What has really happened is the bank has pre-booked an income. Let's see how the bank was able to book this 5 as income in the first place. Ideally, what should have happened is bank should have kept the book value as 95. So the time of maturity, it would have received a principal back of 100, translating into a gain of 5. So at that point, it should have booked as income, which it has pre-booked at the time of purchase itself. So in a way, it has pre-booked the income that would have received eventually, since the security was purchased at a discount of 5 at the time of acquisition itself. Alright, now we'll talk about the concept of marking to market or M2M. So marking to market is done for investments in the trading book, which is your AFS HFT portfolio. What we do here is we compare the book value of the securities in this portfolio to the market values at any point in time. Most often we see it happening on the 31st of March. So there are two possibilities when we compare the book value to the market value. It could be market value is higher than the book value. So essentially there is a gain. We ignore this gain. But in case the market value is less than the book value, this means there is a loss. For this loss, we make a provision which is known as IDR, Interest Depreciation Reserve. Although the name suggests it's a reserve, it's actually a provision. You would have noticed that we are doing this for trading book only, which is AFS HFT. Why not HTM? See, in HTM, the idea is that we'll be holding the securities till the maturity. So there is no impact of market involved. Let's say if I purchase that on a premium, let's say 105, then I'll amortize this premium and eventually I get the principal of 100 back. So there is no loss or no gain happening here. In other case, if I had purchased on a discount, let's say discount of 5%, even then the eventual value that I'll be receiving is 100, the face value or the principal value. There would be a gain of 5. Since there is no scenario where there will be a possibility of a loss, we don't make any provisions, because provisions we know are made for expected losses. The intention behind this mark-to-market exercise is to get a sense of the realizable value of an asset, which in this case was investments. We do similar exercise for the advances. When we try to assess the asset that we have created in terms of advance, would that be realizable or not? In case we feel that it would not be realizable, we make provisions for it there as well, which is known as BDDR, Bad and Doubtful Debt Reserve, which in the first year as a substandard asset starts with 10% and goes up to 100% as the time goes by and we don't receive any income on it. Whereas in the case of investments, we don't start with any arbitrary value such as 10% and keep increasing proportionately as the time progresses. Here we know what is the realizable value of assets and at any point in time, because the securities are getting traded here in the market. So at any point in time, we know how much would be the realizable value. So accordingly we make IDR. If there is no requirement, there will be no IDR created, because both IDR and BDDR, in both the cases we are assessing expected losses and making provisions accordingly, so that if the need be, if the assets become unrealizable, there is no sudden adverse impact on the profitability. Although in general we do mark-to-market provisions only for AFS HFT portfolio and not the HTM portfolio, there is an exception to this rule. In case the securities in the HTM exceed the permissible limit of 25% of NDTL, in this case the securities exceeding this threshold will be mark to market. This rule is there because there are banks which typically put all their government securities under the HTM category and do all the trading activity from there without realizing that HTM is meant for keeping only those securities which will be held till maturity. So in such scenarios, securities exceeding this permissible threshold will be subjected to mark to market. Before we dive into the calculation part of marking to market, there's one rule that we need to know, and that is we cannot offset any gains or losses across any investment category or across any investment type. So as we are aware, there are three investment categories: AFS, HFT, and HTM. And there are five investment types: government security, other approved securities, shares, bonds of PSU, and others. So in this 5x3 matrix, there are these 15 cells or groups. So what we need to remember is within any group, netting is permitted, but it's not permitted across the category or across the investment type. Let's say I had two securities in this first group, which is the government securities, which are under the AFS category. Let's say there were two securities, security 1 and 2. So when I compared the book value of security 1 and 2 with respect to the market values at that point in time, let's say on the first one I had a loss of 10 and the second I had a gain of 5. In the second group, which comprised of government securities under the HFT category, two securities were there, security 3 and security 4. Let's say both had a gain of 5. So what we see here is in the first group, there is a net loss of 5. So remember, within a group, I can do offsetting. So minus 10 plus 5, there is a net loss of 5. Whereas in the second group, I had a net gain of 10. So now if I were to assess how much of IDR is required, it will be simply 5 because we cannot offset this loss against this gain that we had. What we are supposed to do, we are supposed to ignore the gains and factor in only the losses. Within the group, we were able to offset the loss against a gain, but this cannot be done across the categories. So the net IDR required here would be 5. Alright, let's look at another example to understand this mark-to-market calculation better. Let's say I had three securities, security 1, 2 and 3, which I purchased on the 1st of January 2020. Security 1 was for 105, which was at a premium. Security 2 was for 100 and security 3 was for a discount at 95. So the first security I classified as HFT, which is held for trading, and the rest two under AFS category. So these three values, 105, 195, all three are the book values, which are equal to the market value at the time that we purchase. And we know that for the AFS HFT portfolio or the trading book, the book value remains the same even if it was purchased at a premium. It is not going to change. However, if there is an adverse movement in the market value with respect to the book value, then we'll make a provision for it, but the book value will not change. Let's say when we are marking to market on 31st March 2020, that is at the end of the year, the market value of these securities at that time is 110, 95 and 90. So these are the market values. When I look at the first security, I see a gain of 5. Whereas for the rest of the two, I see losses of 5. So as we know that we can offset the gains or losses within this category, which is AFS, but any gain or loss cannot be set off against the other category, which is HFT. So you see here we have a net loss, net depreciation of 10, as we have nothing to set this off against. And we know that we need to provide for the losses and ignore the gains. So this would be the amount of provision that we'll need to make. How do we make provision? We'll debit the P&L by saying provision for depreciation in investment by 10, and correspondingly we'll make a mark-to-market provision or IDR on the liability side. We'll credit this item by 10. Okay, now let's move forward to the third year. So let's see what's the position on 31st of March 2021. Let's say first securities market value was 100, for second it was 110, and for third it was 90. So when I do the mark-to-market calculation for the third year, I'll be comparing this value of 100 with the book value of security, which is 105, and not the previous year's value, which was 110. So we'll be comparing 100 with the book value, which was 105. So what we see here is a loss of 5. For the other security, the book value was 100 and now it's become 110, so there is a gain of 10. Whereas for the third security, its original book value was 95, now it's 90, so there is a loss of 5. Since both the securities belong to the same category, which is AFS, we can offset the loss of 5 against the gain of 10. So there will be a net gain of 5 for the AFS category, whereas we have a loss of 5 in the HFT category. So the provision or idea required would be 5, as we will be ignoring the gain and only considering the losses. So the point to note here is that we need an idea of 5, but we already have an idea of 10, which means that we have an excess of 5. Do not get confused that we had this previous requirement of 10 and now we have an additional requirement of 5. So total required would be 15. IDR calculation is done each year, and for each year we calculate it separately. The previous years are to be ignored because IDR requirement is a dynamic thing and depends on the latest position of the market value with respect to the book value. Hence in this case there is an excess of 5. What we can do with this excess 5 is we can convert it into IFR by reversing it. But the point to remember here is that IFR is a reserve, whereas IDR is a provision. So both are not comparable. This is an above the line item or a provision, whereas IFR is created out of appropriation, or it's a below the line item. And remember that a below the line item can be freely exchanged with another below the line item or any reserve, because reserves are below the line items, whereas a provision, which is an above the line item, can be moved here and there within the above the line items, which are provisions. To transfer this idea, which is an above the line item, we need to reverse it, and then there will be applicable taxes, there will be outflow towards the statutory reserves, and then the residual will flow towards the below the line item, which is IFR. So there's a process. So for now, let's compare and contrast these two items, IDR and IFR, to get a better hang of these. One common thing is that both are required for the securities in the trading book, which is your AFS and HFT portfolio. You know, IFR requirement is 5% of the AFS HFT portfolio for both tier 1 and tier 2 banks, whereas IDR requirement is dependent on the position of book value relative to the market value at any point in time. Now let's look at the differences. See, IDR is created out of provisions. Like all provisions, this is for the expected losses, whereas IFR is created out of appropriation or below the line, that is the value that you get after paying the taxes. Hence it's a reserve, and like all reserves, it's created for the unexpected or unknown losses. IFR is only required when there is a net depreciation, whereas IFR is always required so long as we have the securities in the AFS HFT portfolio. This will always be required as 5% of that portfolio of the trading book. The banks are expected to make IDR only as much as it's required. There is no real tangible benefit that they get for the required amount in neither net worth or the CRAR, whereas IFR can be scaled up to 10%. For the net worth calculation, the banks get benefit for the excess part, that is more than the 5% value required, and in CRAR you get full benefit provided that's been created out of appropriations and not provisions. If there is any amount that has flown out of provisions, it will be ignored, so it gets full benefit as tier 2 capital. Let's take a moment to understand the difference between a provision, which is above the line, or any item created out of appropriation, which we call a reserve, which is also called an item created below the line. Let's look at a P&L to see where is that line that we are talking about. So in any P&L, the top line is operating income. That is income from interest. This could be from advances or investments, or other operating income such as commission, exchange, brokerage, a profit on trading in securities, forex income, dividend income. So this is your operating income. Then there are operating expenses such as interest expense on your deposits and borrowing. There could be other operating expenses such as staff expense, rent, insurance, auditor's fee, etc. When you net these two items, you get operating profit. And then come the items which are known as provisions. These could be your provisions on advances, which is called BDDR, provisions for the investment assets, which is IDR, or even the standard asset provision. These are all the provisions. This leads to the next item, which is called net operating profit. Then you have profit or loss on the sale of assets other than investment, such as fixed assets. This brings us to the profit before tax. On this you pay taxes, then you have profit after tax. From this profit after tax, you make all the appropriations. So the line is this line. Everything before taxes is called above the line, because for those items there is a potential to get tax benefit. So the items like provision get tax benefit to a certain extent. As for all the items that have been created below this profit after tax, the taxes have been paid on them, so they are called appropriations. So all the reserves that you create flow out of here. From this profit after tax, either this money will be going out from the bank as dividends, or it will be plowed back in as reserves. The first prominent reserve is the statutory reserve. So IFR is one such reserve. There could be building fund. There could be various other reserves. And these all reserves, are for unexpected losses. And since we follow the principle of conservatism, all that is expected would have already been provided for as a provision above the line. So expected losses are taken care of beforehand. And for the unexpected, we have these reserves, which could be specific or general, and depending on which they'll be classified as either tier 1 or tier 2. So all the items above this line are called the above the line, and below are called the below the line. And now comes the point that you can move your money across these provisions freely. That is, you can transfer your excess standards provision to BDDR, let's say. This is totally okay. But you cannot transfer directly a provision like IDR to IFR. Why? Because there are items such as taxes and statutory reserve that come in this flow of funds. I'll have to pay taxes, I'll have to transfer the certain amount required for the statutory reserve, and the remaining can come in the IFR, but not the whole amount. Similarly, if I were to reverse the excess IFR towards the IDR, or any reserve for that matter, I'll again have to account for all the layers that are there, which includes your statutory reserve and taxes. In other words, you can freely move funds across the above the line items, let's say from an SAP to BDDR. And similarly, you can freely move funds across below the line items, let's say a building fund or an IFR, but you cannot directly transfer the whole amount between the two items when one belongs to the above the line category and the other belongs to the below the line category, because we know that there are layers in between such as taxes and statutory reserve. These have to be taken care of, and then we can make that transaction happen. Alright, the next topic that we're going to cover is the shifting of securities. So while shifting is permitted across all three categories, HTM, AFS and HFT, various restrictions of course in terms of timing and frequency will specifically focus on the movement to and from HTM category. And why is that? Because HTM categorization offers a unique benefit of immunity from mark to market. So there is no mark to market that we need to do on the HTM. So the banks try to take advantage of this unique feature, and while doing so they violate several guidelines. We'll see what kind of advantages they try to take by shifting of securities to and from HTM via examples. One more thing which you may note here is that this is a second situation wherein there is a possibility of change in the book value of a security. The first one was, of course, when we amortize the premium on a HTM security. And while we are changing this book value, in any of the two situations, be it amortization or shifting, one thing is common, that the book value will only reduce and never increase. And this is because we follow the principle of conservatism, which means that we'll never overvalue any asset and will never overstate or overbook any income. So the book value will always decrease. Alright, let's see what our master circular says on this shifting of securities to and from HTM. It says, banks may shift investments to and from HTM category with the approval of Board of Directors once in a year. And this one such shifting will normally be allowed at the beginning of the accounting year. So another important guideline that we need to be aware of is that transfer of scripts from one category to another under all circumstances should be done at the lower of book value and the market value on the date of transfer, and any depreciation while shifting the security at the lower of two values across categories, that depreciation should be fully provided for. Alright, let's say the bank purchased a government security at a premium at 105 and classified this as AFS, and let's say this was purchased in January 2020. So this is its book value. Let's say towards the end of the financial year, let's say the last week of March is here and the government security is now trading at a lower price. Let's say it's at 100 now. So the market value is 100 now. And we know that for AFS securities, we have to do mark to market. Now the bank notices that the end of financial year is here and we need to do the mark to market calculations and make provisions for the depreciation. And in this case we are getting a depreciation of 5. This much IDR will be required. If IDR is not there, we will have to make provisions for it. This will decrease our net profit, meaning that we'll be able to distribute lower dividends, so the investors will be unhappy. Or let's say their performance is linked to the bottom line, which is the net profit, so their bonuses will be lower. So how do we circumvent this? We see there is a requirement of 5. What we can possibly do, the bank is also aware that no such requirement is there under the STM category. So what the bank does is it transfers the security at the book value, which was 105, to the STM categories and thereby avoids the mark to market provision requirement, as STM does not require this mark to market calculation to be done. So many banks think this way and they just shift the security at the book value itself. Now this practice is totally wrong. This cannot be done. Why? Because the market value is lower than the book value in this case, and we know that the shifting happens at the lower of the two values. So the right thing to do would have been to shift this security at 100. And how would that happen? We'll see that now. Let's say the bank had a IDR of 20. So what our guidelines say is that you'll have to shift the security at the lower of two values, and while doing so, whatever is the depreciation that is there, which in this case is 5, needs to be accounted for either by debiting the P&L or by utilizing the excess IDR. So in this case, notice that the book value is changing from 105 to 100. So we are decreasing the size of balance sheet by 5. How would that happen? We'll have to correspondingly debit something on the credit side, which is IDR. So IDR will also correspondingly reduce by 5 and will remain as 15. Had there been no IDR, we would have debited the P&L by 5. So on the asset side, we saw a reduction in the value by 5. Correspondingly, there was reduction on the credit side or the liability side as well, wherein we reduced the IDR by 5. Or if IDR was not there, we would be debiting the P&L by 5. Thereby, the balance sheet size would be shrinking. Sometimes banks misinterpret this guideline. What they do is that they keep the book value same and argue that we had sufficient IDR at that time of shifting. So what they are essentially doing is they are not changing the book value, which is against the guideline, as our circular states that the shifting should happen at the lower of two values, not the same value, and they show adequate IR on the day of shifting and then reverse it later and argue that they have complied with the guidelines. This often happens in UCVs where the circular does not fully explain the mechanics of it. It just says transfer of scripts should be done at the lower of book value and market value, and any depreciation on such transfer should be fully provided for. So the bank just stick to the provided for part and ignore the first part, which says the shifting should happen at the lower of book value and market value. In case the market value is lower than the book value, then certainly the book value will change, and that can only happen if we debit the P&L or reduce the IDR, which is evidently clear in the circulars for RRBs and the commercial banks, where full mechanics of this shifting at lower values is explained. If we were to just provide for it at the time of shifting, we would simply shift all our securities from AFS to HTM All those securities whose market value is lower than the book value should happen for the securities with lower coupons. You could simply take them all and make them immune forever by shifting them to HTM by making just one-time provision and then reversing it later, thereby making all these securities where there was requirement of IDR perpetually immune to any marking to market requirement. Certainly, this is against the spirit of the circular. The very reason we are saying that the shifting from AFS to HTM should happen at the lower of two values is so that the banks are not able to escape this requirement of IDR. Like in this case, I cannot just shift this 105 security at 105 and not make provisions at the end of the year. When I shift it at the lower of the two values, which is 100, I am essentially recognizing the depreciation that has happened. So the book value changes to 100 forever, and we have booked this loss of 5 by debiting the P&L or reducing the IDR. Let's look at another example to understand it better. Let's say in January 2020, I purchased a government security at 105 and I classified it as AFS. And now we're in the month of March, let's say 30th March 2020. During this time, let's say the interest rates have risen significantly, thereby reducing the market value to 90. So this is the market value as on 30th March. And the bank is aware that for this reduction in market value over the book value, it will have to make a provision. Let's say the existing IDR was 10. Let's say the bank is not fully aware and he thinks that he'll be able to bypass this requirement of marking to market by shifting the security to HTM, because in HTM you don't have to do marking to market. Let's say the bank transfers the security from AFS to HTM on 30th March at the book value itself at 105. Now this cannot be done. This is wrong. Why? For two reasons. First, the guideline says that to and fro shifting from HTM can only happen once, and that too at the beginning of year, not on time like this, that is towards the end of financial year, where we can anticipate potential mark-to-market requirements. Therefore, this movement across HTM is permitted only at the beginning of the financial year. Since we are doing it in March, it's not permitted. Second, even if it were the beginning of the year, the shifting will happen at the lower of these two values, which is 90. So we'll be shifting this 105 security to the HTM category at the book value of 90. That is, we are reducing the book value from 105 to 90, which is minus 15. Now we can see that the debit side balance has reduced by 15 as we change the book value from 105 to 90. Correspondingly, we'll have to reduce the credit side balance. That happens by debiting the IDR, and since IDR is not adequate, we'll have to debit the P&L as well by 5. So the credit balance decreases by 15 as well. The trial balance is tallied. The size of the balance sheet has shrunk by 15. So whenever you shift a security from to and from HTM, we essentially freeze any mark-to-market loss that's happening. If such restrictions such as the shifting needs to be done at the beginning of the year, or it needs to be done at the lower of book value or market value, if such restrictions were not there, the banks would be freely moving securities across categories to and from HTM and avoiding the potential mark-to-market provisioning requirement. Another thing that gets impacted by this reduction in book value is the eligible balance towards the SLR requirement. When I reduce the book value, the eligible balance shrinks by 15. If I don't change the book value, I am overstating the eligible SLR balance. This may even lead to default if I was not maintaining adequate buffer. While we are on the subject of overstatement of SLR, there are two other typical ways in which the banks try to inflate the SLR balance. What happened in one bank was it sold its SLR security but never recognized this transaction in the system. We kept that balance for few days and later reflected this transaction. So all this while he was overstating the balance. Second thing which they typically do is they would rather not amortize the premium in the HTM category. So we know that the premium on any security which is under HTM needs to be amortized. Let's say if I purchase the security at 105 and 5 years is the residual maturity, then each year I'll be decreasing it by 1. So it will be 105 in the first year, then 103, so on and so forth. What they would do is that they will not reduce the value until the last year, thereby enhancing the eligible SLR balance. Few other pointers related to shifting include you need to check how many times was the security shifted. It is very possible that you may see a security under the AFS category at the beginning of the year and under the same category at the end of the year, but it might have moved to other categories during the year. Don't just look at the beginning of the year category and the end of the year category. It might have moved to HTM and then again come back. So all those time shifting was happened. The guidelines need to be followed. Second thing is you have to be very careful while looking at the shrinkage of the book value or the reduction in the size of balance. Let's say a security was purchased at 110 and was under AFS. During the year it was shifted to HTM at 110 itself when the market value was 107. Let's say the market value was lower, but still it was shifted at the book value. And during the year, the bank amortized the premium and reduced the book value to 100. Now, at the end of the year, it again brought it back to the AFS category at 100. And let's say the market value at that point was 105. What would you do in such a scenario? When the bank had already amortized the premium, would you still further reduce the size of balance sheet by 3, taking into account the fact that the market value was lower than the book value at the time of shifting? So all these things need to be carefully considered while looking at how much of IDR needs to be reduced or how much of PNL needs to be debited. The bank might have already done it, although for a different reason or accidentally. Alright, the next topic is income recognition on investment. It happens in two ways, on accrual basis and cash basis. For accrual basis, an example would be government securities, and for cash basis, one typical example is mutual funds. Let's first have a look at what the master circular says. So this bit is for the cash basis and this part is for the accrual basis. For cash basis, let's see what the guidelines. For cash basis, it says income on the units of mutual funds, debt mutual fund or money market mutual funds, and equity of AIFIs, which is All India Financial Institutions. This includes NABARD, SIDBI, Exim Bank, and NHB. So in case of mutual funds and equities of AIFIs, income should be booked on cash basis and not on accrual basis. And this was done as a prudential measure and to bring uniform accounting practices amongst all banks. Let's see the cases wherein we can book income on accrual basis. So it says, however, in respect of income from government securities or bonds of public sector undertakings and AIFIs, where the interest rates on the instruments are predetermined, income may be booked on accrual basis, provided interest is serviced regularly and is not in arrears. So in all such cases, we can book income on accrual basis. So the inference that we can draw here is that whenever there is uncertainty about the quantum, timing, or receipt of income, the examples of which could be mutual funds, bonds of private companies, in such cases, we'll book income on cash basis. We are essentially being conservative about the likelihood of realization of income. Therefore, we'll book the income only when we receive it and not on the basis of any expectation of income or any notional gains in the value. In such cases, we will not book the income. We'll only book when we receive the cash, as we are not sure whether we will receive the income or not. Whereas on the other hand, when the instrument is issued by the government or any government-owned entity, wherein the quantum is known and is paid regularly, in such cases we can book income on accrual basis. Why? Because the government is backing it. There is no uncertainty as such. as we are sure about the quantum and the regularity of the payment. Hence, we assume that we'll be receiving the payment, so we book the income on accrual basis. Let's look at an example to understand the accrual basis better. Let's say I purchased a government security of face value as 100 on the 1st of January 2020. This security gives me a coupon of 12%, which I receive on a half yearly basis on two dates, which is one is 31st December and the other is 30th of June. So since this is a government security, I'll be booking the income on accrual basis. So the next coupon that I'm going to get is on 30th of June. However, since I can book income on accrual basis, I can recognize the income for the months that I have been holding this security, even though I haven't received it yet. Why? Because this is government backed. So although I'll be receiving income 6 months down the line, I can book it as income as I have earned it, although I haven't received it. So let's say 3 months have passed and it's the 31st of March 2020. So for the 3 months that I've been holding this security from January till March, I can book an income of 3 since the interest rate is 12 and I've been holding it for 3 months. So the entries would be, I'll be debiting the interest receivable on investment account by 3 and I'll be crediting it as income in the P&L under the head interest on investments by 3. So you can see I've booked the income on 31st March, although I haven't yet received it. So let's see what happens on the 30th of June when I actually receive it. Let's say 3 more months have passed and it's the 30th of June now. So during these 3 months I would have booked the income of 3. So interest receivable would be 6 by now and the interest earned would have increased by 3. So net income that I've booked so far is 6. So what happens when I actually receive it? So on 30th June when I receive the payment, the entries that will happen is I'll be crediting this income receivable, so it will become 0 and I'll be debiting the cash by 6 as I've received it now. So the receivable has converted into cash. Notice that there will be no impact on the P&L side, which was the interest on investment account, because we have already booked the income. Even before I received the payment, I booked it as income because I had already earned it. Although I had not received it, but I had earned it, so it's already been booked. So when I actually receive it, I'll be only converting this interest receivable by crediting it by 6, thereby reducing the balance to 0, and at the same time debiting the cash as I've received it now. Alright, now let's look at an example wherein we'll be booking income on a cash basis, such as mutual funds. Let's say the bank purchased SBI mutual fund in January 2020 and paid the acquisition value of 100. So 100 was invested in January 2020. Let's say on 31st March 2020, which is at the end of the year, the market value of this investment becomes 120, implying a gain of 20. What some banks do is they book this notional gain as income. What they would do is they'll say interest receivable on mutual fund, create this account and debit it by 20 and correspondingly credit the P&L and book income under the head interest income on mutual fund and credit it by 20. Now this practice is totally wrong. The bank cannot do that. Why? Because on mutual funds or any such instrument which is not backed by government, or even if it's backed by government, the quantum is not known and is not paid regularly. In all such cases, we book income only on cash basis. That is only when we realize the gains or receive the income, not on notional basis. It's the same thing as ignoring the gains in case of marking to market calculations. Since we haven't yet realized the gain, we can't book it as income. If the bank were to actually book this as income, what it should have done, it should have pulled out all the investment as well as the gain from the market and then only book this as income. What would have happened then is we would have received a cash of 100 as well as 20. So we will have debited the cash by 120, credited this mutual fund by 100 and credited the P&L by 20. We could do so since we had pulled the money out and actually received the gain. Unlike the previous scenario wherein we just created entries but we never really pulled the money out of the market. Why cannot we book this gain on accrual basis? Since there is market risk involved. Unlike government securities where the receipt of income was certain, here there is market risk and we do not know the value of this 120 would increase or decrease tomorrow. Tomorrow it might turn to zero. The private company or the entity could go bankrupt and we might never receive the money that we had booked as gain. There's a possibility that we could lose our original investment as well as the gain that we have booked. So essentially putting money in mutual fund is like making investment in a stock. Nothing is safe or certain, not even the originally invested amount. So the bank needs to pull the money out of the market, book the gains, realize that as income in the P&L, and then it can again reinvest that whole amount of 120 back. That way it can book the income. So this practice of booking income on instruments like mutual fund is very common. One way to spot that is you might see items like interest receivable on non-SLR securities or interest receivable on mutual funds. These items are not supposed to be on the balance sheet or trial balance. Why? Because you cannot recognize any income unless you actually receive the cash. There will never be any receivable. When you get the cash, you book the income. No conversion of receivable to cash.